Well, greetings and welcome again to our monthly newsletter update. I guess driven mainly at the moment with a budget coming up next week, and we've had 3 profit downgrades in our terms over the last week from the federal government. So a surplus became a $7 billion, $12 billion, now a $17 billion deficit, $80 billion possibly over the next 4 years. So that's a pretty serious matter, and over time that can impact on credit ratings. So we won't jump the gun, and we'll get something out next Tuesday after the budget. But significant savings are going to need to be made to balance the budget. And I guess part of the problem has been that the income that's been projected hasn't been correlated with the expenses. So some of the income hasn't come through, obviously, on the resources tax, on the carbon pricing, but the expenses certainly have, because they're not correlated to that revenue. The Reserve Bank surprisingly dropped interest rates earlier in the week to a 60-year low, 1960, to 2.75, and that might sound a bit of a shock to the system. I don't think the market was really expecting it. But the graph you see attached with the newsletter shows interest rates around the world, particularly from our 8 major partners. Now, the salient factor is that we are still the most expensive, or the highest of the 8. Which means money is still coming into Australia from countries like Japan, seeking to get higher rates of interest there. So we can't be an island in ourselves. We need to see what the rest of the world is doing, and so much of this is correlated that that the decisions made on interest rates are as much around overseas matters as they are around our own. But an Australian dollar above parity certainly is a major headwind for exports, for tourism, and this is an issue that's been here for some time. So do look at those interest rates. Interesting though, the next question is, well, what are people going to do with the savings? Now, Maynard Keynes wrote about the paradox of thrift after the Second World War, which basically said, while it's a great thing for individuals to save money, it's a bad thing for a community as a whole to save money, because that can lead to deflation. It can lead to an expectation that assets won't grow in value, exactly what we've seen in Japan. So at the moment what we're seeing is certainly a change of culture that we're seeing in our client base at the moment, to more to saving, more to a conservative attitude. People are getting older, which means more and more of the capital now is in the retirement phase. This is why the income streams from dividends is so important to give a reasonable return when interest rates are coming down. Last week ANZ and Westpac reported, NAB reported today, and basically paying out close to 100 cents in the dollar when you take back the franking credits in dividends there. So tough at the moment, hard to drive revenue growth. It's very much about reducing expenses and then paying out as much of the profits as possible in dividends. So the banks have done well, and if you look at the overall market at the moment, the Dow hit 15,000 last night, which is another all-time high. We're at a 5-year high, so when you look at it, we've had share markets at 5-year highs, we've had debt at 25-year lows, 50-year lows maybe. This should be a good time to invest. It's really now about getting some confidence back into the community. That confidence probably will sit on the sideline till we have an election, or certainly till the budget next week. So we need to be cautious in what we're doing, but not overly pessimistic at this time. Finally, we have a function in a couple of weeks' time at Hugo's, which I very much look forward to seeing as many of you as possible. We're making huge strides forward on our website. We'll be having private logins for you soon, where you'll be able to see your own financial affairs with us as we move to a more online sort of world. Outside of that, we're working very, very hard to meet your needs and requirements, and we have had quite a few referrals, so very much appreciate that. So that's enough for today, and I look forward to seeing you. We'll get a note to you after the budget. Take care, bye-bye.